Hello, my name's Peter Mothy, and I'll be your presenter today for Trademark Capital Management's review of the December 2025 FOMC meeting. I have a number of slides to get through today, so let's get started with those. December 2025 Federal Reserve meeting notes were as follows. The Fed cut interest rates 25 basis points or 1/4% to a range of 3.5 to 3.75%. This was a surprise to absolutely nobody. Future cuts will have a higher bar, the chairman said. Also, the Fed will begin buying $40 billion in Treasury bills, they said, to add liquidity during this holiday season, starting this month and ending in the first half of 2026. This month's decision was not a unanimous decision, as it was expected not to be. Also, the Fed is expecting one cut in each of the next 2 years. Sorry for the misspelling. Taking Fed funds down to what is presumed to be a neutral rate of 3% to 3.25% in 2027. Now, the rationale for the decision was that inflation remains elevated at 2.8%, but estimated at 2.5% in 2026 and 2.1% in 2027. 2.1% is very close to the Fed's target 2% rate. The Fed remains more focused on unemployment or employment, as you might want to say, than on inflation at the present time. Labor demand and labor participation are both softening, which is the key concern of the Fed. The economy is expected to grow 2.3% in 2026. This is a fairly robust increase from the expected 1.8% or so in the last meeting. Unemployment at year-end 2025 is expected to be around 4.5%, possibly 4.4%, and decline in both the next 2 years. Now, the yield curve, which we've looked at each of the previous months, you can see in black the yield curve as it existed 1 year ago. In blue, you can see the yield curve as it existed yesterday on the day of the Federal Reserve meeting. The green line represents a typical spread of interest rates over a 30-year yield curve. And you can see that if the yield curve does go to 3% neutral rate in the lower left-hand corner, then long-term interest rates in the 30-year range are already where they're expected to be. Well, what does this really mean? It means that if the Fed continues to lower rates as they're expected to over the next 2 years, we can expect to see the Fed funds rate drop down to 3% to 3.25%, but we should not expect to see interest rates at the right-hand side of the curve or the long end of the curve decline by much, if at all. And this is important because there is always a lot of talk out of the administration about the Fed cutting interest rates so mortgages will get cheaper. Mortgages are already where they are expected to be if the Fed cuts rates all the way down to 3%. Now, the last graph that I have is an important one because this shows in green the marketplace, the open market bond market for 2-year Treasury notes against the Fed funds rate that the Fed sets itself. These are not set by the open market. The green line tends to lead very accurately the black line or the Fed funds line. For well over 2 years now, the green line has been well under the black line. This simply means that the open market, the bond market, has been expecting the Fed to cut for well over 2 years now. However, as of yesterday, on the right-hand side of the graph, you can see here, the cut in the interest rates, the Fed funds rate, has now taken the Fed funds rate down to the same level as the 2-year Treasury note in the open market, meaning that both the open market and the Fed agree on the interest rate level today. So for now, there is no pressure from the open market per se on Fed funds to be lowered in the immediate future. Now, what does this mean for investors? An immediate decline in interest rates for money market funds and savings rates we'll see in the next few days. A slow growing economy with a risk of future negative surprises is possible. No or slightly lower bond, auto, and mortgage rates. And that was illustrated in the yield curve shown just a moment ago. Investors also should expect a tightening of lending standards due to the slowing economy. This will drive continued increases in loan and credit card delinquencies, which we're already starting to see, as well as bankruptcies. Now, you can follow Trademark Capital Management on the web at trademarkcapital.com. You can reach us at info@trademarkcapital.com. You can follow us on X, YouTube, and LinkedIn. If you have any suggestions for future videos, please let us know. We'll be glad to accommodate. And thank you very much for joining us today.